Welcome back to Rockstock Channel. Matt Fernley, you were on last year talking about dirty graphite, and we hope to have you on sometime in the future to talk about graphite again. But today we wanted to have you on because toward the end of last year, you wrote this great note, how high can lithium prices go? And then you put out a very popular tweet last week about kind of constrained and unconstrained EV penetration. So would love to talk lithium today with those two as our guideposts. But before we do that, could you introduce or reintroduce yourself and what you do?
I'm a geologist by training. I've been in the equities research, the commodities research industry for 20 years on and off as both a equity analyst and a commodity analyst. Obviously, I have a lot of experience of forecasting demand trends, forecasting how materials behave, and pricing trends, etc. And we track all of the information that I feel is important to taking a view on these materials and also on the stocks that are producing these materials. As well as battery materials review, also work as head of research for Westbeck Capital's Volta fund, which is an energy transition fund. So I do actually put my money where my mouth is.
Again, battery materials review, is that just a monthly subscription? You also have a podcast. You interviewed Ken Brinsden a few months after we did. What's it cost and what do you get?
Battery materials review for private individuals, it costs £480 a year to subscribe. That gives you 12 issues. For corporates, it's £1,200 per year to subscribe. We also do the Recharge podcast on a monthly basis, and I have a co-presenter, Cormac O'Lara, who's a battery expert who's based in Hong Kong.
So let's go into this article. I mean, that's the main crux of this. How high can lithium prices go? If you could kind of just lay out briefly the arguments you put into that. Spodumene prices to go as high as 5,000 and lithium carbonate prices to go as high as 60,000, which is quite a bit higher than spot prices are, and absolutely, outrageous if you were to think about 12 or 18 months ago where prices could go.
Yeah.
Whereas sell side analysts are much lower than that. So how do you get to your prices, and what is everybody missing?
We are now in virgin territory for lithium prices. They've never been this high. So how do you forecast a price of an industry where you've never seen prices that high before? What I did for my methodology is I went back to the materials super cycle between 2003 and 2007 to 2008. And I looked at the behavior, the relationship between prices and demand and prices and industry size during that event. So when China was urbanizing, we saw a major secular demand event, and we also saw a very tight supply event, similar to what we're seeing in battery raw materials now. And I basically looked at the correlation between the amount that prices rose during that event and the market size for each of those commodity/materials, and then applied that to the battery materials and where we were now, and lithium in particular. And the initial work I did in this was in October 2020, and I initially published in October 2020 saying that lithium prices were likely to quadruple from the levels that they were at that time. And everybody said, "You're nuts, you're absolutely crazy. There's no way lithium prices are going to go up that much." Actually, as it happened, I was conservative, and lithium prices shot right through those targets. And I think that's a factor of how tight the market is and in what sort of level of deficit the market is at the moment. So we went back and we brushed off our data, and we looked at quarterly pricing rather than annual pricing, and we did a little bit more detailed analysis, and basically the numbers that you described earlier, $5,000 a ton for spodumene concentrate and $60 a kilogram or $60,000 a ton for lithium carbonate, that's what came out of our upgraded analysis. And even though those numbers sound absolutely crazy now, if I look back over what happened in the commodity super cycle, at the beginning of the super cycle, we expected $1 copper was crazy. And at the end of the super cycle, we got to $4 copper. So, you know, my view is if you have a secular demand event and a tight supply situation, you are going to get prices overshooting what you ever thought they could be. And, you know, based on my experience, I think, you know, one of the issues that we have at the moment on the sell side is there aren't a lot of analysts who've actually had experience of forecasting a secular demand event. And that's a key concern. You know, we've made all those mistakes. I've made those mistakes. The people I work with have made those sort of mistakes. And I didn't want to make them again. So I wanted to go in with what I thought was a more realistic forecast, rather than being in a situation where I have to take my forecast up 30% every 3 or 4 months or so.
You walk through, there are 3 bullet points here in particular.
First of all, I think there is an assumption in the market that 100% of the lithium carbonate that comes out of Latin America is battery grade. And it's not. It could easily be only 70 to 80% of the material that comes. And yes, a lot of that material can be upgraded to battery grade, but some of it can't. And in the process of upgrading that material, you get what are called recovery losses, where not all of that material survives the processing to be used. So if an analyst is suggesting that 100% of material coming out of these operations in Latin America is battery grade, then they're overstating. The second point is a similar point, and a lot of analysts look at the hard rock production that's coming out of Western Australia. All of that is going into the battery industry. And it's not actually true, because what happens is the spodumene concentrate that comes out of Western Australia then has to be converted to lithium chemicals. So that basically then goes through a second stage of conversion, and that has a recovery factor as well. So only 85 to 90% recovery levels are viable for spodumene concentrate. So a lot of analysts are forecasting that 100% of the spodumene concentrate that's produced out of the mines goes into the battery industry, and it's not. It's only 85 to 90% of that material. So again, analysts are overstating supply. The third point on supply I want to make is that new projects have a history of disappointing, shall we say. Generally, these projects take a lot longer to ramp up than expected. And on top of that, at the moment, we're also dealing with COVID-related supply chain issues, and particularly issues with sourcing labor in a lot of these key regions like Western Australia, where a lot of these projects are coming on. The final point is on demand, and it's a really core thing. And to understand this point, you have to think about how analysts are forecasting demand for battery raw materials. Because what analysts are doing is they're looking at EV sales forecasts, and they are working back from what the EV sales forecast is into what battery demand is, and therefore into what raw material supply is, raw materials demand is. And they are missing out one very core segment. And it's a little bit of a dirty secret in the battery industry, that there is this thing called battery yield, that a lot of the batteries that are produced by these factories are faulty. They either fail production tests at the cell factory, or they fail production tests at the EV factory or downstream of there. So if analysts are not factoring in battery yield of, say, 70% of capacity, then they are massively understating demand. A lot of the raw materials that are used to produce batteries are effectively wasted because they produce faulty batteries.
Okay, great. That's awesome. Thanks for walking through that article. And before we get into more kind of Q&A, let's turn to this tweet you put out between constrained and unconstrained EV penetration. If I look at your numbers, I see 2030, you're estimating in the constrained scenario, EVs globally will only be 20 million in total.
Yeah.
But Tesla, and all of its fans, who follow them, basically said they alone will produce 20 million units. So will Tesla have 100% market share in 2030?
What we've basically found over the last 4 or 5 years is that the amount of investment that's going into the EV part of the supply chain is about 8 to 10 times the amount of investment that's going into the raw material part of the supply chain. And given it only takes 2 years to build a factory and it takes between 3 and 10 years to build a mine, what we're looking at here is a structural undersupply in battery raw materials. And basically that's the reason why I built this this way of modeling. So over the last up until the middle of last year, I was at the top end of consensus for my EV sales forecasts. And over the course of the rest of the year, I fell from the top end of consensus to the bottom end of consensus. And the reason I did that was because I couldn't take my EV sales forecasts up anymore, because based on my bottom-up modeling of raw material supply, there wouldn't be enough lithium and other raw materials to make that many EVs. And, we've seen we've seen sell-side EV sales forecasts go through the roof over the last 6 months or so. And it seems to me that the sell side, because they haven't got their supply demand forecast right on the raw material side, is overestimating the amount of electric vehicles that have been made. And I just wanted to find some way to show what was actually going to be viable off the raw material investments that have already been made, or the feasibility studies that have been done. So that's what that chart is aimed at doing. And to come back to your specific question, my view is that the OEMs are being completely unrealistic. Not just Tesla, but other major OEMs are being completely unrealistic about the amount of EVs that are going to be able to be produced if there isn't a substantial investment in the upstream part of the industry very, very quickly indeed.
Matt, every day I'm watching CNBC. It's now January 16th. I could point to 3 or 4, CNBC high profile, segments where they're talking about lithium shortages, and then Byron Wien, we have talked about this, who put out a famous forecaster now at Blackstone, ex Morgan Stanley, basically in his top 10 predictions said that what you're saying is that raw material supply constraints are going to prevent EV penetration being as big, or there's a significant risk of that, and then Chamath Palihapitiya is basically saying, a famous investor, battery materials is the scope. So your chart is reflecting, and you've done a lot of the bottom up work. It's starting to penetrate mainstream financial media. We had a fair bit of financing last year. I calculated $7.5 billion in lithium financing. I think I saw on your blog that you forecast a bit more than that, and then you looked at all the other metals, but it still pales in comparison, you're right, to all of the EV investments that are being made. But you just had, LG Chem went public, raised $10.5 billion for their LG Energy Solutions. Will they use some of that capital to invest in upstream raw materials? Will Ford, if they sell their stake in Rivian, use some of that? Because Jim Farley at Ford has talked about, going all the way up to the mine. Do you see the battery companies who have very big market caps, have a lot of the cash? The cathode makers can't do it. They're not really making any money. The Teslas of the world, the auto OEMs of the world, the big battery companies have signed, offtakes here or there, but haven't really written big checks. Do you need that, or is it all just going to be capital market funded? And you have seen capital markets responding, but is it fast enough?
I think the big issue here is that, since 2018, when obviously the battery raw material markets peaked, it's been very difficult for mining companies to raise capital. And if you look at the industries that are leveraged to the battery supply curve, the only industry that currently is sitting on net cash positions is the auto industry. So, you do expect the auto companies to have done their homework and realized that there is a big imbalance in this industry, but clearly they haven't. And this is the problem that we're dealing with. Yes, now the battery companies are sitting on a fair amount of cash, or some of them are, but a lot of that cash has to go into their own expansion. At the end of the day, the auto companies are sitting on quite big net cash positions, plus cashing up from all of these SPAC deals, etc. And I like to see the auto companies coming to the market, because at the end of the day, they're the guys that are going to get stuck between a rock and a hard place with this. Most of the battery manufacturers have raw material price pass-through clauses, and the auto companies don't, because effectively their end consumer is us. And why am I going to go and replace my ICE vehicle with a vehicle that costs twice as much? And I'm not. So the EV story succeeds or fails on whether auto companies can provide EVs at a reasonable price. And of course, if raw material costs are going up, battery costs are going up, it's going to be increasingly difficult for them to do that. So I really would like to see the auto companies starting to move. Many of us in the industry, you, me, the guys from Benchmark, other guys in the industry have been saying this for 3, 4, 5 years now. And it's clear that the auto company management teams have not done their homework. I think auto companies are used to dealing with mature industries like steel, where they turn around and say, yeah, I have another 10,000 tons of steel this month, or actually I need to cut my buy to 10,000 tons less of steel next month. And, that's easy in a mature industry like steel. But in an industry where like lithium, where we're going to need 7 times the current size of the industry within the next 10 years, it's just not possible. And I just don't think that the auto industry has gone any further than perhaps the battery side with its industry analysis. And the other major issue I think that we're dealing with at the moment is, if you look at the procurement departments of the auto industry, we're definitely starting to see some movement in the last 12 to 18 months. I can name 4 or 5 different auto manufacturers which now have raw materials procurement departments that didn't have them 12 to 18 months ago. But almost to a person, the people who run those departments are, shall we say politely, 20 to 30 years younger than the people who sit on the boards of these auto companies, and probably 4 or 5 levels of management below them. And I think that's the problem. The people who are in the procurement departments, they know now that there's a problem. The people who are on the boards of auto companies, they're still living in cloud cuckoo land. And that's the issue that we're dealing with. So we need the auto companies to wake up very rapidly to understand that there is an issue. If auto companies invest now, you can still head off the issue by 2028, 29, 2030. Not for the next 5 years, but maybe for the end of the decade. But they have to start investing now in those projects.
You have seen auto companies last year sign offtake agreements with geothermal projects using DLE extraction. So, Volkswagen and Stellantis and Renault. So is this a reflection that they finally understood that they need to lock in supply security?
Yeah. So in terms of the offtake contracts with the auto companies, I've said it so many times, you've said it, we've all said it. In my view, offtake is not enough. For the auto companies, because they're moving so slowly, because the Western world auto companies have moved so slowly on this, what's left in terms of offtake is either very early stage projects, which aren't that developed, or it's what I would call less plain vanilla projects. So plain vanilla projects in the lithium area are things like hard rock spodumene, which we know can be upgraded to lithium hydroxide, or brine projects, which can make lithium carbonate. Less plain vanilla projects are untested technology at the commercial scale. So things like geothermal projects relying on direct lithium extraction, or sedimentary lithium projects. You know, we know they work in the lab, but we don't know if they work at large scale on a commercial basis for battery grade lithium. So, you know, it's all very well that some of the Western auto companies have signed up these offtake agreements with these DLE geothermal projects, but we actually don't know if those companies are going to be successful at producing the stated amount of product to the correct specifications in the time schedule that they've set out. So for me, that, you know, that's the risk. And as I've said before, offtake is just not enough. These companies have got to deploy their balance sheets and start investing in the industry. Because the other point that's a big issue is the sort of investments we're seeing are only in producing assets or assets that are close to production. And if we genuinely want to have a viable industry, we need to start investing further down the value chain. It's got to start investing in juniors and making capital available for juniors to go forward and develop and explore and find the assets of tomorrow. And you know, that's a big area that the industry is just not looking at the moment.
We know we have a problem. It looks like unquestionably we're in structural deficit now. So the question now is, Matt, if an OEM came and asked, you know, what is it that you see as the fastest route and flow sheet to increase battery grade lithium supply? How would you answer that question?
If it was a specific OEM, I would sit down and say, look, these are my 5 most favorite projects, which are close to production or in production, or maybe a little bit away from production. I suggest you buy one of these and use the material from this project, because if you do that, then you could effectively be paying the production cost of lithium carbonate or lithium hydroxide rather than the market price. For if it's the auto industry, what I would say to them would be, go out, take a couple of $2 billion and finance as many projects as you can, because only by financing a lot of projects are you going to push the price down. It won't be for the next 5 years, but beyond that, you would be successful in pushing the price down if you finance a lot of projects. But it's only by deploying your balance sheets that you're going to get yourselves out of this.
Tolling spodumene concentrate in China.
Yeah.
To utilize the excess capacity that's there, is that a viable option for you?
I think that most spodumene concentrate producers are quite keen to go fully integrated over time. So when capital is available for them, I would expect them to set up their own integrated lithium chemicals production. So I think the tolling industry in China is going to struggle.
Do you see, you know, Canada is a meaningful supplier of both spodumene and chemicals in the future, especially if you look at some of the quality of the ore bodies and low impurities, and the fact that they have access to low GHG hydropower?
Absolutely. I mean, I'm really excited about Canada, not just in lithium, in nickel, in graphite as well. I think Canada's got some of the best resources in the world in lithium, in graphite, in nickel. A lot of these unexplored and undeveloped, really world-class hard rock spodumene assets out there. And, you know, given that it's got access to a lot of hydropower from both an efficiency standpoint and also from a CO2 intensity standpoint, it makes a lot of sense for Canada to set itself up as a major battery raw materials production center. You've obviously got, you know, the potential of the US EV industry sitting just to the south. And I think I think Canada should obviously invest in raw material production, but I also think Canada should invest in processing. So why let that raw material go over the border in its raw form? You should process it also in Canada, potentially put the cathode plants in place as well, and then ship cathode south of the border into the US cell factories. But for me, Canada should be looking to fully integrate itself in the battery raw materials industry. Is a huge once in a lifetime opportunity for Canada based on the resources that it's sitting on. You know, in the super cycle, we saw a lot of downstream industries coming in and making money available to mining companies, junior mining companies. And we've got to see that going forward. You know, as we all know, with investing in junior mining companies, not all of them are successful. But you've got to create a sort of nucleus of companies that can be successful and go to the next stage.
I guess that's the whole point, really, is if you know only a percentage, therefore it's a numbers game. You
need to finance a lot of projects, and that's the issue that we're dealing with at the moment. I mean, in Battery Materials Review, I've sort of split the lithium developers and explorers into generations, and I regard the junior companies of this era as generation 4. And over the course of 2021, I think we raised something like $150 million for generation 4. It's just not enough. We need 10 times that amount to take generation 4 ahead. So, we need to get that capital from somewhere. Now, I'm sure some of it will come from private investors, but at the end of the day, more of it could come from downstream in the battery industry who clearly have, access to that sort of capital.
It's funny you mentioned generation 4. We're calling this kind of lithium, we're in lithium 3.0, but the new exploration company is lithium 4.0. But if you look at our scoreboard, if you compare March 2020, the bottom of COVID, you saw a whole bunch of assets, some companies relatively reasonably advanced, at 25, 50 million market cap. And now you're seeing brand new exploration juniors, raising 10, 15 million dollars, and they have 25, 50 million market cap.
Yeah.
So there is funding coming out. The next generation, we've been associated with a few of those, and we're going to be talking about those new companies in throughout this year and in coming years.
It's riskier, but there are obviously, for a private investor, there's more money to be made in the smaller companies at this stage in the cycle. Early on in the cycle, you want to focus on the production companies, the assets that are in production that have got operating leverage. As the cycle moves on, investors are looking to take on a little bit more risk and to move into the juniors a little bit more. So yeah, it makes sense to be looking for the early stage opportunities in what's likely to be a multi-year cycle.
It's a good point. Rodney was saying, last year we experienced, 5 times upside, 5 years of upside in 1 year. So
Yeah.
A lot of, and luckily we were watching it very closely and well positioned, and hopefully followers of Rockstock channel and our work have benefited from that. But the question is, you can't talk about individual stocks because you represent a hedge fund here, but on balance, what's more likely to triple, right, or quadruple from here? A company that's already 4 or 5 billion market cap, or one that's 25 or 50 million market cap. So
yeah, exactly. And also the juniors are adding a lot of value. So, if I go from a situation where I don't have a resource to a situation where I've got 20 million tons at 1% lithium oxide, then obviously I've added a lot of value. And, I could triple, quadruple, go up 10 times or whatever like that. So yeah, I think, as the cycle matures, you start to look a little bit lower down the market cap spectrum to realize appreciation.